damn it, I did it again. The mute button was on when I did that intro. So here's what I said if you're watching live. When it comes to real estate investing, there are thousands of ways to structure a partnership. But today, I'm going to talk about just one way that apartment complex partnerships are built. All right. So yesterday, I gave you a slight breakdown. I'll get to that graphic here in a minute of a general partner versus a limited partner and a high level of their individual responsibilities. But today, I want to dive a little deeper into that and kind of walk you through just how you, as a passive investor, will get paid. Not just how you're going to get paid, but when you will get paid too. So before we begin, let's make an assumption, right? Let's assume you're a limited partner, also known as a passive investor, in an apartment complex, and you've invested $100,000, right? 100,000 just because it makes it easy, easy math. It also goes with the graphic that I grabbed from one of the deals that not only did I analyze, but I am a limited partner in. So I'm very familiar with that one, and it just makes it a lot easier for me. So before we get into that, my name is Jay Helms, and I'm the founder of the W2 Capitalist. Been a real estate investor since 2000, an active real estate investor since 2014, 2015. My wife and I have 328 units in our portfolio right now, and we're actively looking for apartment complexes, 15 to 200 units from Mobile, Alabama to Jacksonville, Florida. Mainly in class B and C, not the A's nor the D's. But anyway, let's get into this as I've been tinkering around with this application here to do some transitions and make these graphics a little bit better for you. Let's see how this works. All right. Look at that. Look at that awesome stuff. But anyway, general versus a limited partner. I think if I show this, it's going to go over. Anyway, let's just dive into this. You guys can, I'll put a link over there, way over there, that'll link to yesterday's video about the difference between a general partner and a limited partner. What I want to talk about today is how a deal is structured for you as a passive investor, how you're going to get paid and when you're going to get paid, because they vary, right? There are thousands of ways to structure a real estate investing partnership. But when it comes to apartment complexes, I have seen everything from monthly distributions, which is pretty aggressive, to quarterly distributions. And then depending on the situation, let's just say it's a half-filled property, that distributions won't happen, for a couple of years, right? So if it's one of those scenarios, they just vary widely. But I want to go through this just because it was something I could easily grab out of one of the deal packages, or also known as an investment summary, that a syndicator sent to me, that I've actually engaged in this relationship, and this is what we're going through now. So they give an example of this. And by the way, your syndicator should always give you an investment summary, go over it with you, whether it's through a webinar or a one-on-one, having some coffee or having a drink or whatnot. But that helps qualify you as a sophisticated investor, right? So as long as you've had the deal package or the investment summary, then you've went through it, you understand it, it helps qualify you as losing my spot here. Helps qualify you as a sophisticated investor if you're not accredited. So want to go through this. This is a 172 unit apartment complex I'm a part of in Greenville, South Carolina. So the way this is structured is that for you to look at, hey, how am I going to get paid, right? What's the cash flow? And then what am I going to get paid when this thing actually sells or we refinance? Most deals that all the deals that I'm a part of, the plan is to refinance or sell the property within 3 to 5 years. So we're going to take advantage of those cash flows. And I'm going to talk to you as if you're a limited partner, but I'm going to talk as if I'm the limited partner in this, because in this deal, I am actually a limited partner. To kind of give you my feedback, giving you my experience on what it really feels like to be a limited partner. It's the best thing in the world, by the way. I'll just summarize it as that. But literally, don't do anything. I get a check in this case from these guys monthly, and with an email that says tells me what's been going on with the property and what's been going on with the local economy due to what we're going through with COVID-19. But it is great. It truly is the closest you can get to being a passive investor. So with this, I want to walk through, and I'm working on some tools so I can actually mark on the screen and do this, but you guys just kind of bear with me. But the investor distribution of cash flow, right? So if you want a preferred return, those investments are out there. Now, preferred does not mean guaranteed, right? It does mean that you, as a limited partner, you're going to get that 8% before the general partners get anything. Highly recommend that to be part of any deal that you look at. The investment summary that I sent out to some of my potential partners, it actually doesn't have that in there because it was an older investment summary that I've used before. And so again, deals can be structured hundreds of ways, right? You as a passive investor, you need to look for one that you're comfortable with signing up for. So preferred is a great one of those things because it lets you know that right off the bat you're going to get paid before the general partnership gets paid, which is how it should be structured, which even in the deal that I'm in is how we're doing it. It's just not, because it is definitely a friends and family type of deal. We didn't get into this level of how it was structured. So, but we're absolutely doing that. So 8% preferred to investor, right? And then there's a 70-30 split after that. Now, what that means is back to the limited partner versus general partner. So once these returns get above 8%, and you will get, it's usually quarterly, regardless if you're a monthly distribution or if you're on quarterly distribution or whatnot. Usually quarterly, you're going to get a statement that shows you how the property has performed for that period of time. By the way, I skipped coffee this morning and went straight to the hard stuff, Coca-Cola. I know a few folks that work at Coca-Cola. Maybe they want to sponsor this show. No. I will work for sugary water. It's okay. But yeah, so let's get back to the preferred return. Again, preferred does not mean guaranteed. Every risk has an investment. You should know that. There's probably some disclaimer in the paperwork you're going to sign with your syndicator. But after you get that 8% return, there's a 70-30 split, which means if this property just kills it, right? I'm going to use round numbers to make the math easy as I'm doing this on the fly. Let's just say that this property gets an 18% return, right? So you get your 8% preferred. That means you're going to get paid first as a passive investor. Then what happens with that remaining 10% is it split 70-30. So you will get 7% of that, and then the general partnership will get 3%. So overall, this would be a 15% return just on the cash flow, right? Now, the membership ownership here is a little technical for what I want to get into for this 20 minutes. I'm not going to actually get into that. Let me just put it to you that way, because it involves IRR. IRR is a little different, but typically IRRs, you want to look at something where it's around a 13% IRR. Usually 12 to 15% is a pretty good range. And the way this is structured here, this is not a bad deal. Otherwise, I wouldn't have invested with it. But what I'm saying is it's just a lot more technical for me to try to walk you through here at this moment in time. Let's talk about what's down below that. Hopefully you guys can see I don't know if you can see my cursor or not. But the investment returns based on your $100,000 investment, right? So you invest in $100,000, and then in year one, so the moment the close happens on the property, the clock starts, right? So in year one, your anticipated return is just the preferred, right? It's just going to maintain, and you're going to get the anticipated, right, is $8,000 over that first year. Now, that could be quarterly distributions, that could be monthly distributions, basically and it could be an annual distribution. It just depends on how the partnership is structured. Basically, what you want to do is if you're looking at this anticipated number, take it, divide it by how many months that you're going to get paid out, and that's going to be your cash flow for that time period. As you can see, years 1, year 2, 3, 4, the cash flow starts to improve because the assumption there is, or at least the plan, is that we're going to, not me because I'm a limited partner in this scenario, that the general partners are going to do an awesome job of reducing expenses, and then they're going to do an amazing job to the improvements of the property. This was a slight value add, meaning that it was under market rents, but it was also needed some repairs. So it came in, they actually started doing some repairs. I think, so this started, we closed on this in August of 2019. And I believe we're like a month or two away from being done renovations, if I'm not getting that story mixed up with another property. But in that renovation, rents are going to go up, right? So you can see kind of how the projections are for that, not only the annual percentage of return, but also the investor return for my $100,000 investment. Now, let's focus on year 5, which is the big payout, right? So keep in mind, 5 years ago, let's just fast forward to 5 years. I invested $100,000 into this project. It has worked out. The guys who underwrote this deal knew exactly what they're doing, and they have hit the nail on the head every year. Year 1, I got $8,000 in cash flow. Year 2, I got another $8,600 in cash flow. Year 3, $9,141 in cash flow. Year 4, $9,515 in cash flow. So far, that $100,000 investment has yielded me. Oh man, I should have done this math in a cheat sheet before. 16, 25, $34,000, right, in cash flow. Well, then in year 5, we're either going to refinance it. And when I say we, the general partnership is going to decide what to do, because that's how the deal is structured in the operating agreement. Operating agreement is an entirely another episode where, I mean, there's just so many different ways that you can slice and dice this thing. Real quick on an operating agreement, I don't know if that's something I'll do on a YouTube live because it's very specific to a deal and can get very complicated. The thing about an operating agreement is the two things that you want to make sure you understand completely is who has voting rights, and when those voting rights happen, what happens if the general partnership doesn't do what they're going to say they do? How do you rectify that? And the last thing on that is make sure your attorney reviews it for you, right? To make sure it's not something that somebody's trying to pull. Not necessarily that there's somebody's trying to pull wool over your eyes, because you wouldn't be in the situation of talking to a relationship if you already didn't have a relationship with a syndicator and at least trust them that this deal. But it's always a good idea to have the attorney look it over. It's going to cost you a small little consult fee. Highly recommend it, right? Just make sure you've got somebody in your corner that can read through all the lingo of an operating agreement. Make sure it jives with your investment strategy. But year 5, this is where the general partner. Excuse me. What happened there? Whoa, went away. But year 5, the general partnership decides, okay, we're going to refinance the property, right? We've got enough equity into it. We're going to return the original investment to our partners, to our limited partners, and go forward where we're going to. They've still got equity into the entity that holds this property, so they're going to still continue to receive those cash flows after we refinance the property and return their initial investment to them. So that's why in year 5 you see the 158,522 is not only did I get my initial investment returned, but I also got $58,000 more, right? So the reason why I love this deal is if you look at it, I have almost doubled my money in 5 years, right? Uh, that is if everything happens, everybody does what they're supposed to do, including the economy, which we're in the middle of the COVID, and I don't think we've seen the ripple effects that's going to cause just yet. So I wanted to go through that to kind of give you guys a highlight of what a deal structure can look like. Now, again, there are thousands of ways to put these things together, and they can get extremely difficult. I tend to keep things simple, and one of the things that I don't do is if I don't understand the operating agreement or the deal structure, I ask, right? Ask, make sure it makes sense to you. Just understand the most important thing is how you're going to get paid and when you're going to get paid. Those are the two things. The other thing it mentioned too about most general partnerships, they will have stipulations in there, not general partnerships, general partners have the ability to decide when cash flows are going to happen or when distributions are going to happen and when not. So let's just say you're on a quarterly distribution and there's been a fire, there's been something that's affect the cash flow of your property. Well, the general partners more than likely will not do a distribution at some point in time during you hold that property, because what they don't want to do is they don't want to come to you and say, look, we've had a rough couple months with cash flow. We've blown through our reserves that the bank's making us hold. We need more capital, right? That's called a capital call. No syndicator wants to get into that situation. So if you go a month or two or a couple of periods, whether it's monthly, quarterly, I don't think annually distributions are gonna go away. Unless there's special circumstances, right? Like if you get into a property that's 50% occupied, that's a little understandable because you have to build that thing up. But the thing being is just know how you're going to get paid, know when you're going to get paid, and expect that everything's not going to go according to plan, right? Now, the great syndicators will talk to you and they'll deliver right before they get paid, right before the general partnership gets paid. They want to make sure the limited partners are taken care of and that they get those numbers that they've been talking about and wanting to. I don't know if you just heard a little pterodactyl in the other room, but that was number 3. She screamed really loud. But those general partners want to make sure you as a limited partner are taken care of before they make any money. At least that's what they should do, because they realize that, hey, if I'm giving you the returns that I expect, then the next deal that comes along, or that you expect, the next deal comes along, you're going to say, look, hey, we had a great run. Let's just roll this thing over, right? Let's go to the next one. And that's what I try to do as a syndicator as well, is make sure that the partners are taken care of first. And then because I wanted to reinvest, I lost my train of thought, because I want them to reinvest with me, right? So that's just one example of how a deal can be structured. There are thousands of ways to do it. The biggest thing, and it goes back to point number 1 on this 4-element series I've done this week, is that you have to have a trusting relationship with your syndicator / general partner to make sure they're going to take care of you, right? That's the biggest thing. But yeah, ask me anything in the comments. I'm looking for my button here, but there it is. Ask me anything in the comments. I want to do a 100 like goal. I'm still striving to do that. I know there's a lot of people who have been subscribing here recently. A lot of people watch and they'll still don't hit the like button, which is okay, because it tells me that I got to work on my content. But if there was something in here that you enjoyed, just hit the like button for me. Let me know that that's the kind of like the vote up that lets me know as a tuber, which I never thought I'd say that, but as a tuber, what I would need to work on and what is popular for all the subscribers that have on the channel. So you guys make it a great day. I will talk with you soon. Drop me some questions and comments in the chat box so I can gotta get these buttons down so I can help you understand this just a little bit more. And I will see you tomorrow. Tomorrow I'm wrapping up this 4-element series I've done this week, talking about one thing that you absolutely need to invest passively in real estate, and that is money. See you then.